Then let's move on to the foreign exchange market. Foreign exchange market. Foreign exchange market. Foreign exchange market. Foreign exchange market, also known as Forex or FX. Foreign exchange. It is a market. Foreign exchange market, first of all, is a market. And it is one of the largest financial markets in the world. It's one of the largest. Foreign exchange market, also known as Forex, is the largest financial market in the world. It is where currencies are traded. It's a market where currencies are traded. It's just one market, just one. Whether you are converting your money from mafarangas to Uganda shillings, or you are converting the yen to dollars, it's just one market. All that exchange, we are calling it foreign exchange market. It's just one market. It's a market where currencies are traded. That's the definition. Foreign exchange market is a market where currencies are traded. Who are the participants? The players in this market? Financial institutions, commercial banks, central banks, all the central banks in the world. We have all commercial banks. Central banks engage in this trade. Commercial banks engage in this trade. Investment banks hedge funds. If you walk in town here, you also have forexes. We have retail investors. Try and cross the border here in going to Uganda here in Busia, you find individuals selling currencies. That is still part of the foreign exchange market. Now, what are the features? of this market. One, decentralized. This market is decentralized. It is decentralized. The Forex market is decentralized, meaning there is no single physical location where trading takes place. Transactions occur electronically between banks, between corporations, individual traders, and so on. Continuous trading. Trading in the foreign exchange market is continuous, 24-hour trading. The market operates 24 hours a day due to the global nature of trade and finance. High liquidity. High liquidity. The forex market is highly liquid. What does that mean? Meaning that the large amounts of currency can be bought and sold quickly and easily. Leverage. The fourth feature is in relation to leverage. Traders can use leverage to magnify their profits or losses. However, leverage also increases risk. And talking about risk, we have volatility as a feature. Volatility. Exchange rates can be highly volatile, meaning they can fluctuate rapidly and unpredictably. Interconnectedness. Interconnectedness. The forex market is interconnected with other financial markets such as the stock markets, the bond markets, the derivatives markets, and so on. Speculation is a feature of the forex market. A significant portion of forex trading is driven by speculation, as traders attempt to profit from changes in exchange rates. What can we say about regulation of foreign exchange markets? Now, while the foreign market is the forex market is largely unregulated, there are some regulatory oversight to prevent market manipulation and ensure fair practices. So these are features of foreign exchange market. Related to foreign exchange markets, we have what we call exchange rates. Exchange rates. Exchange rates. Exchange rates. What are exchange rates? Now, exchange rates are the prices at which one currency can be exchanged for another. It is the rate at which one currency can exchange with another currency. And the exchange rate is a crucial factor in international trade, in investment, in finance, and so on. And there are different types of exchange rates. You must have heard about the spot rate. The spot rate. We are discussing types of rates, exchange rates, export rate, spot rate, spot rate. Now, spot rate is the rate at which currencies are exchanged for immediate delivery. Spot, on the spot. Forward rate, forward exchange rate, or just forward rate is the rate agreed upon today for the exchange of currencies at a future date. Future date. This one is immediate. This is at a future date. The rate that is agreed upon today that will be paid at a future date. That is future. All right, future rate, the price of currency. That is the forward. Let's make the distinction. Can this? We have forward rate and future. That we need to make the distinction, that we don't confuse the two. The forward, we have first of all the forward rate, which is the rate agreed upon today for the exchange of currencies at a future date. That is the forward rate, as I explained. Then there is the future rate, futures rate, not future but futures, futures rate. Futures rate is the price of a currency contract. Make the difference. See the difference. Futures rate is the price of a currency contract. It is the price of a currency contract that will be settled at a future date. Then you have the swap rate. Swap rate. Swap rate, on the other hand, is the rate at which two parties agree to exchange currencies for a specified period. They may have a reverse exchange at the end of the period. We now move to consider what we call foreign exchange exposures. Foreign exchange exposures, from the word expose. Now, foreign exchange exposures refers to the risk of financial loss or gain arising from fluctuations in exchange rates. It is the risk of financial loss or gain. It's the risk of financial loss or gain arising from changes in exchange rates, arising from changes or fluctuations in exchange rates. It is the risk of financial loss or gain arising from fluctuations in exchange rates. And this exposure can affect businesses, individuals, governments that have transactions or assets denominated in foreign currencies. So if you have assets denominated in foreign currencies, and when you say assets, you are not just referring to the tangible assets. You may be referring to the instruments that are traded in the international capital markets or even in the international money markets. Because if you're holding a bond or a treasury bill, that is an asset to you. It's an asset. So you can be affected by fluctuations in exchange rates. If you're holding a treasury bill or you're holding a bond or a stock in foreign currency, then there is that risk of financial loss or gain. You may gain or you may lose because of the fluctuations in the exchange rate. There is a way in which the rates may move, which may occasion a loss or gain. You understand? Types of foreign exchange exposures. We have one type known as transaction exposure. Transaction exposure. Transaction exposure is a type of a foreign exchange exposure. This one arises from future contractual obligations to pay or receive foreign currency transaction. It can be positive, that means receiving foreign currency, or it can be negative, which means paying foreign currency. For example, a US exporter, or let me say importer, take an example of an US importer who is buying goods from a Kenyan supplier on credit. That may expose him to what we are calling transaction exposure. There is also another type known as translation exposure. Translation exposure. Here we are dealing with the risk that may arise from the translation of foreign currency. All right? Let me put it another way. A translation exposure, candidates, arises from the translation of foreign currency denominated assets and liabilities into the domestic currency for financial reporting purposes. Translation exposure. It is the risk of financial loss or gain arising from fluctuations in the process of converting one currency into another. This I know you covered in your, consolidation of group accounts? You recall translation exposure? If a company has a foreign subsidiary and the assets, liabilities are to be denominated in the currency of the parent who is in another country. So there could be gain or loss as the balance sheet items are translated from one denomination, from one domestic currency, from the foreign currency to the domestic currency. You can take an example of R&D's company with a subsidiary in Europe reporting its financial results in euro dollars or in mafarangas. Understand? So that is translation exposure. The other type of foreign exchange exposure is economic exposure. Economic exposure arises from changes in exchange rates that affect a company's operating cash flows. And this can be positive or negative depending on the company's competitive position and depending on the pricing strategy of the company. That is economic exposure. You can take a Kenyan exporter facing increased competition from foreign producers due to a weak Kenya shilling. So these are three main types of foreign exposure. So it is not enough to just discuss the types, it's important for us to at least discuss briefly hedging. How do you hedge? How do you reduce the risk of financial loss arising from fluctuations in exchange rates? So managing foreign exchange exposure can be done through hedging. So hedging is one way to manage foreign exchange exposure. Let me say managing, then hedging. How do you manage foreign exchange exposure? One way is through hedging. Again, we'll be looking at illustrations on this, on how to hedge. That means using instruments like forward contracts, futures, options, swaps in order to offset the foreign exchange risks. Managing can also be done through matching. Matching is the process of structuring assets and liabilities in foreign currencies to balance exposure. Another way to manage foreign exchange exposure is through netting. Now, netting combines foreign currency transactions to reduce exposure to risk, or to reduce overall exposure. I think the key word there is overall exposure. Combining foreign currency transactions with the purpose of reducing overall exposure. 4, currency diversification is another way to manage foreign exchange exposures. That means spreading foreign currency transactions across multiple currencies to reduce what we call concentration risk. Concentration risk. You understand, candidates? We are trying to simplify, candidates, this to demystify, using non-technical terms to define technical terms. Candidates, foreign exchange exposure, these are types, and these are ways to manage the risk of financial loss that may arise from fluctuations in given that there are no questions, we will close the lesson until another time when we continue to study the topic international financial management. Bye bye.